Hey, it's Joe Crump. I've been getting several questions and having several conversations with investors who have cash to invest and are interested in our Done For You program, our GRS program, our Get Rich Slow program, and us having us build a portfolio of properties for them. With the goal being a $200,000 investment, bringing them $100,000 a year of income, net income after a 10 or 15 year period, and then also doubling the value of the property during that time and increasing the income along with inflation. So some really nice, attractive ideas. We've been looking at different price ranges for these properties, everything from $125,000 up to about $400,000. The hypothetical situation or hypothetical house that I'm going to talk about here is a $380,000 house. And we're going to look at it two different ways. We're going to look at it with 20% down, which are the types of loans that we can get with the DSCR loans. And it gives you, some pretty nice leverage with the property, but has a little bit of negative cash flow on a $380,000 property. And compare that versus a 40% down, and the return on investment you can get with that. And the reason we're doing 40% down is because that would be with a non-recourse loan. And typically, non-recourse loans only go up to, say, 60%. I've seen them go to 65 or even 70%, but most of them require, 30 or 40% down payment. So I thought, let's go with 40% down and show you the difference between the return on investment with, 20% leverage and 40% down leverage. So you can see that and see how that all breaks down. So let's talk about a $380,000 house, $20,000, $40,000, and 40% down is the non-recourse loans that you need in order to do it with a Roth IRA. A non-recourse, by the way, means that the lender only has recourse on the property itself. So if you default on the deal, they can only take back the property itself. They can't go for recourse money, which means any money that might be above and beyond that still might be due on that particular loan. So in this scenario, and this is based on a real property that we've been looking at, $380,000, $2,600 a month of rent on that property. 80% loan to value would require $76,000 as a down payment, and then 5% of the loan amount, and the loan amount's $304,000, so $15,000 on the loan amount, so about $91,200 is the approximate total investment on this property. The PITI on that property would, at 30-year mortgage, 8.5%, would be $23.21. That's principal, and interest is $23.21. The TI, the taxes and insurance, is $400. Property management is $260. So if you add all those together, you're going to get $29.81 principal, interest, taxes, and insurance plus property management. That would be the monthly cost, the monthly outgo for that property. That means you've got $381 a month negative cash flow from the actual rent. And I want to talk about that in a minute. But first, let's go and look at a 60% loan to value. If you put 40% down, that means you've got $152,000 down on that property. And 5% on the loan amount of $228 is $11,400. So your total investment in this property, in this scenario, is $163,400 for one property with a $228,000 mortgage, and principal and interest coming to $1,741. Taxes and insurance, property management are the same as it is up on the 80%. So 400 plus 260, add those together and you get 2401 principal, interest, taxes, and insurance plus property management. So you have positive cash flow of $199 a month on when you put 40% down instead of 20% down. Now, your rent is going to increase 5% a year. And if you look at the rent increases over the past 5 or 10 years, we've seen anywhere from 5 to 15% increases in rent. So we're trying to stay fairly conservative with the increases, and the way we structure our deals, we build in rent increases on 3-year lease options so that it goes up 5% every year. So the second year we would go from $2,600 to $2,700. Third year we go to $2,800. Fourth year we go to $2,900. So the cash flow changes each year, and it starts out on this 80% loan at $381 a month negative cash flow. Remember, you've got this $2,981 going out, and you've only got $2,600 coming in, so that leaves you $381 negative cash flow. That means the first year, if you multiply that by 12 months, it's $4,572 negative cash flow. Second year is $3,372 because the rents go up $100. So now your cash flow goes down by $100. So now you're down to 33. Third year, you're down to 21. Fourth year, you're at 972. The fifth year, you're at positive cash flow. And that doesn't include the down payment assistance that we get for the lease option that we're doing on these deals. So we're getting extra money every month, and I'm going to talk about that in a minute, that will actually offset this negative cash flow. And assuming that we get it, will make you positive. So the total negative over the 4 years, these numbers here, over the 4 years is $11,000. So if you want to figure out, if you put this $11,000 into pressing the wrong buttons. If you put this $11,000 into the cost to purchase it, and your original cost to purchase it 80% down was $91,200, then it'll increase that to $102,288. So this, you want to have this money in reserve if you're going to take on negative cash flow. You want to have that sitting in the bank. During those 4 years, just you got to know that it's there so you can cover your negative cash flow. Now, which I don't think is bad. I'm going to show you the numbers and how it plays out in a minute. Now let's go and look at the 60%. It's already in positive cash flow of $199 per month on the first year. Second year, $299. Third year, $399. Fourth year, $499. So each year, that positive cash flow goes up because rents increase, by about $100 a month every year over time. So every year you're going to get an extra $1,200 on your rent on top of what you're getting already. So you have a total of an investment of $163,000, but you've got no negative cash flow. All right, you've got some other additional income in a deal like this. We're going to sell the property about 10% above what we paid for it. So $380 plus 10% equals $418,000. That's 10% above purchase price. The down payment assistance money that we're going to get from the new buyer is going to be $20,000 at $900. And they're going to be making payments on that over 36 months, the 3 years of the lease option period. So that's going to work out to about $580 per month. We may have to spend a couple of $1,000s on appliances or cleanup or maybe a little bit of new carpet. So keep that in mind. There's always potential expenses on these properties, but it's not terrible with the ones that we've been looking at. The goal here is that we're going to pay it off in 10 to 15 years. So, based on what we're doing here, these properties would pay off in right around 15 years, maybe a little bit less than that. The rent increases from the down payment assistance pays down that mortgage for you. So let's look at these at this income. So the rent in 10 to 15 years, the rent is also going to go up. And by then, it will have almost doubled. So $5,200 a month of gross rent, times 12, $62,000 gross income. So if that's approximately $4,000 a month net. That means you made $48,000 a year, as far as net income after you get the property sold. And it costs you, less than $100,000 to get into that. So if you did 2 of those, you're very close to that $100,000 a month or $100,000 a year annual net income from that $200,000 investment that we talked about. Also, the value on this $380,000 property within 10 to 15 years will also approximately double based on a 30-year history of rents in Indiana. In the areas that we're buying, we see that they go up about 10% a year. Every 10 years, 100%. So over the last 30 years, they've gone up 300%. So over the next 10 to 15 years, it's likely, based on historical data, that it'll go up another 100%. So 380 to, double that. That's 760. I guess I got the number wrong here. So these values would go up fairly dramatically. So you not only have the income that's coming in every month, the $4,000 a month coming in on this investment of $162,000, but you've also got, the equity build up in this property. If you ever got to it paid off, when you got it paid off within that first 10 or 15 years, you wanted to pull a chunk of money out, you could just go refinance it, pull out $600,000, and you could spend that money without paying any tax on it at all. And then you could use the income that comes in from the rent to pay down the new mortgage. And you could take that $600,000 and go spend it on something else. You could live on it. You could invest it in some other place. At the same time, this value would continue to grow, and you'd be able to keep making money on that. Owning these properties like this is just so attractive. Anyway, so let's look at the annual return on investment when you leverage and when you make payments on a mortgage, because there's going to be a difference between 20% down and 40% down on the leverage, and I want to show you the difference on that. Now, the formula for calculating return on investment on leveraged investments are return on investment equals the net profit divided by the total investment times 100. So if you have a $380,000 house, here are the numbers for both 20% down and 40% down types of loans. So 80%, 20% down loan. Total cash investment is calculated as 80%, so $76,000 down. Your down payment or your closing cost, $15,000. That's $91,200 total investment in that. The total net profit is going to be $38,000. That's the 10% appreciation on the property. $3,900, that's a depreciation. That's a tax savings that you're going to get in your pocket. $3,600 is the annual buy down on the note, and that's approximate, but about buys down the note that much every year. The rising rents is about $1,200 every year. And then you got negative cash flow that very first year of $4,500, and this is going to go down by about $1,200 a year until it disappears entirely after the after the fourth year. So your total net profit on this scenario is $42,000 in the first year. Now, if you subtract some possible costs like potential vacancy, I'm figuring 3% annual vacancy rate, which is actually less than, or is actually more than what I have now in my portfolio, but 3% is usually a pretty fair vacancy rate, except during times like 2008 where it jumped up to 20% during 6 months or so during the time right after that 2008 crash. But let's say 3% is your vacancy rate on average. $2,600 a month is the rent, times 3% times 12 is you got to reduce your income by this amount. And same with repairs. So let's say it's $2,500 times 5% divided by 12. That's about $1,500 on your potential repairs annually every year on this property. So your net annual profit breaks down to $42,128 minus your vacancy and repairs. So $39,600 is your net annual profit. And you take your net annual profit, and this goes back to that calculation for leveraged investments to see what the return is. Net annual profit divided by the total investment on a 20% down deal times 100 equals 43.52%. So 43% return on your investment, and that's with 20% down investment. Now, after 15 years, when the mortgage is paid off and the net income is $4,000 a month, you'll have to start paying taxes on this income because it's not inside, a Roth IRA. If you don't have a Roth IRA, none of that matters. You have to pay taxes on your income anyway. If you have a Roth IRA and you're trying to decide, should I pull my money out of my Roth IRA and then invest it, or should I keep it in the Roth IRA and invest it inside the Roth? I think this is going to show us that it probably makes more sense to keep it inside the Roth than to pull it outside the Roth, even though you don't have to pay taxes on pulling it out of the Roth. That's the beauty of a Roth. You don't have to pay taxes on all that income that you made. But if you're in a 30% tax bracket and you're outside your Roth, you're not, your investment's not outside your Roth, then you're going to pay $14,000 a year in taxes, in capital gain, income taxes on that $48,000 of net income that you make. So if you have a Roth IRA money, you wouldn't have to pay any of that taxes, and that's why every investor should have a Roth IRA. If you don't have one, you need to set one up, because there's so many ways to invest in real estate. Most of my portfolio is in my Roth IRA, and so and I'm also over 59 and a half years old. So anytime I want to pull money out of my portfolio, I can do that without paying any tax, any income tax, ever. This isn't like a standard or regular traditional IRA. Those, when you pull money out after all said and done, you have to pay taxes on it. But with a Roth IRA, you don't, because you pay taxes up before you put the money in. Anyway, 2 of these properties with a 20% down gets you to that $100,000 net income with a $182,000 investment. So a really nice return on your money after 10 to 15 years, and then for the rest of your life. And then this income just goes up every year because your rents go up every year. If you have 2 properties, your rents are going to go up, another $2,400 every year. So, it's it's very attractive. All right, let's look at the 40% down. 60% loan to value on the loan, because we're doing it this way is because this is the way non-recourse loans work. They require more money down. That's how they get to this non-recourse thing. So total cash investment, 60% loan to value, requires $152,000 down on a $380,000 property. Your closing costs are going to be $11,400. Your total investment $163,000 on one property. So you can see on 2 properties you got $182,000 over here. You got one property at $163,000, but you're not paying any taxes on the income. So we'll get to that in a second. The total net profit is calculated with $38,000. That's the same annual appreciation on that $380,000 property. Depreciation is the same, about 1%. The annual buy down on the note on this would be about $3,600. $1,200 is the rising rent every year. And this one has positive cash flow. Remember that $199 a month positive cash flow that because you put down more money, you've got positive cash flow. So another $2,300 a month in that. So if you add that up, you've got $49,000 an annual income. That's your net profit on these deals. Now subtract some possible costs. I'm just kidding. These are exactly the same as the other ones. The 936 as the vacancy rate and the 1500 as the potential repairs needed. And then we'll figure the 49,000 net annual profit before costs minus the vacancy and repairs leaves you with $46,652 as net annual profit. So we plug that into our leverage calculator, and so it's 46,652 divided by your initial investment, total investment of 163,400 times 100. Your return on investment is 28.55% return on investment. And I don't know of any other investment that you can do that's a passive investment that will give you these kind of returns. Again, so much of this annual profit is still based upon appreciation. And if it doesn't appreciate, then you won't have that kind of return, but you'd still have return because you'll be owning that property and you'll have income from that property and it'll pay itself off over time. And also there's a 30-year history of the properties that we're buying in the areas that we're buying them going up in value 100% every 10 years. And this is over the last 30 years. It's done this consistently, reliably, even though we've gone through, some tough times during those years, 91 and in 2008. So there's been some times over these last 30 years where there have been some tough markets. Also, after 15 years, when the mortgage is paid off, you've got that $4,000 a month. You won't have to start paying taxes on that. So you'll save $14,000 annually if you use a Roth IRA money. And your return on investment goes up pretty dramatically because about 30% increase in what you're taking home. So 30% of 28.55% is 37.12%. So your actual return on investment, if you figure in your tax savings, is 37% return on your investment. So, and when you sell this property, if you sold it, which you don't want to, you want to hold on to these properties forever and give them to your kids and to their grandkids and on and on and on. But if you did sell it, you wouldn't have to pay any capital gains on that sale. Whereas if you sold a property outside your Roth IRA, you would have to pay taxes on that. If you bought it for $380 and you sold it for twice that, you'd have to pay taxes on the approximately $380,000. And if you're a 30% tax bracket, that's over $100,000 in taxes that you'd have to pay over that period of time. Where here you wouldn't have to pay a dime. Ideally, and logically, I think, you would want to refinance the property and pull your money out if you needed cash rather than selling the property. So don't sell your properties, refinance them, pull the cash out, have your tenant make the payments for you, have it managed by a good property manager and just continue to hold on to it as it goes up in value over time. Anyway, I hope this explains things a little bit better. If you have more questions about how we do this Done For You program, I've got a whole long video on what we do and how we do it and why only we can do it and why we're somebody you should be working with in order to build your portfolio, especially if you have cash to invest. If you go to this URL, jr4.co/doneforyou, all lowercase, it'll give you that video there. It's about an hour and 20 minutes long. So it's very detailed and it goes into this stuff in enormous detail. So we're also and this particular video talks about cheaper properties too, 120 to $175,000, and but we've been buying properties up in the $250,000 to $400,000 price range as well, and finding that the numbers that we're trying to accomplish, the $200,000 investment to bring us in $100,000 annually after 15 years works. With all these models, we just have to tweak it a little bit to make it work for you, and to make sure that the income is there so that you can do it. And we're using a lot of techniques to bring in all this income to make that happen, all these different streams of income to make this happen, to be able to make these properties pay off in that period of time instead of taking 30 years to pay off, and also to be viable investments over that long term. So go check out this website if you're interested in doing this with us. There's also a form there that you can fill out if you're interested in working with us. If you have this money to invest and you're interested in working with us, you can fill out the form and you can send it in to me, and we can talk, and you can call me at this number, and we can discuss working with you. I don't work with that many people, but I do work with a few. And like I said, I created this video because I had a couple of people that came to me specifically because they wanted to use their Roth IRA money, and I thought, let's just make a video that I can give to everyone so that you can see how this works. And if you don't have a Roth IRA yet, you need to be setting one up, and need to be getting that taken care of for yourself, because it can be very attractive. There are some rules about how you can set them up and how you transfer your regular IRA or your 401k over to your Roth IRA, but it's all doable. And if you need some help with that, I can direct you to a good CPA to help you take care of that stuff. It took me a couple of years to find a CPA that actually understood the stuff that I'm doing here, first of all, and how to make all this stuff work. And by the way, if you're buying properties as an active investor, not just a passive investor, you can also do this with zero money, with zero credit. You can do subject to deals inside a Roth IRA. You can do land contracts that have non-recourse clauses inside a Roth IRA. I do all that stuff and have done that stuff, and that's what I teach my mentor students. So if that's something that's interesting to you, you should come and get involved in perhaps my mentor program, or come to one of my buying events, my weekend buying events. All right, why don't I put that link here too. ZeroDownInvesting.com is the information about my mentor program. All right, I hope that helps, and I wish you the best, and I hope we get to work together. All right, thank you. Bye-bye.